Mark Perchtold joins us from London. Good to be talking with you, Mark. Mark is with OMBA, ex-South African, who has now got a global view. Sorry, not ex-South African, Mark. That would be incorrect. You're always a South African, aren't you? You just happen to be otherwise located at the moment. But your London base gives you a very good view on the world. And that's what I'd love to hear from you today, because the world is saying equities are in a bull market again, back up. They're up 24% from the lows. Another part of the world is saying, no, this is just a rally in a bear phase. So give us your expert insights. And we will hold you to it, of course.
Thanks, Alec. Well, just to clarify, as you can tell by my accent, I'm definitely still South African, and I have a South African passport. So I'm very loyal South African, but I am in London. The question of the bull versus bear market, I mean, I think last year was definitely an official bear market as defined, 20% drawdown more in various equity markets around the world. So it depends on which country you look at. Not every market fell the same amount, but broadly speaking, yes. This year we're in a bull market because equities are rallying, and I think bull market is a market that's trending upwards, and from Q4 last year until where we are now, we've been in an upward trend. But there's a distinction between bull and bear market versus recession. And I think the big looming question is, does the world go into a recession at some point later this year or early next year? Bloomberg consensus is 65% of the market think we'll go into a recession in the US. Goldman recently just revised down their expectation of recession to 25%. And there are pundits across Wall Street and in financial markets around the world who have completely opposite views on this. We're somewhere in the middle of that. We think, a recession is reasonably likely, but it's more about the depth of the recession and how long it lasts. There's no doubt higher interest rates are going to put a squeeze on households and corporates as funding costs have risen, and that will actually be quite good for inflation. And inflation will come in hopefully quicker, although it has been coming in quite nicely, certainly in the US and in many other markets too across Europe, although Europe is a bit divergent across different countries. So if inflation comes in, then that gives central banks room to cut rates. And in an environment where rates are cut, you often see a strong stock market rally. And so last year priced in doom and gloom because of higher rates. Doom and gloom hasn't transpired. Employment data is good, economic data is good, PMI data is okay, and the world is not in a recession. And earnings from Q1 were reasonably optimistic and positive. So the dire outcomes that everyone thought would occur this year during the course of last year haven't materialized. And so there are those that are pushing that out to later this year or early next year. So our view would be somewhere in the camp of, yes, potentially 2 quarters of negative GDP growth in major developed economies, but it won't be deep and it won't necessarily be for too long. And that will keep inflation in check. And by inflation being in check, central banks can cut rates and the bull markets can continue.
It's very helpful when you lay it out for us like that, because many people who aren't like you, who aren't spending 100% of their time looking after money and looking at markets, get terribly confused. But if you can kind of see, well, recessions are not good for shares. There is a lag effect, but shares, generally speaking, in the long term, there's going to be more of the shares going up than going down. So in other words, bear markets don't last forever, neither do bulls, but it's likely, because the economy around the world is growing, it's likely that if you were on a 50-50 basis, playing red or black, you'd put your money on bull every time, because it's going to be bull more than bear because economies are growing. But right now, you've given us some very useful insights into how one should view these things, but then how do you structure yourself? How do you structure your portfolio? In particular, why I'm happy we're talking is because you guys take a lot of that risk out by only investing in exchange-traded funds.
Yes, Alec, well, we like the benefits of diversification that ETFs afford you. You're inherently extremely diversified, but there's so many different ways in which you can express a view using ETFs. There are over 8,000 in the world. Which ones you use to express a particular view is very important. That one of the things we're looking at in the last few weeks is the distinction between the market cap capitalization ETFs, which weight larger companies at greater weight. So if a company's double the size of another, it can be double the weight, versus an equal weighted index, which just equally weights all the shares. And the gap between the S&P 500 in the US's market cap index, the normal S&P 500 as everyone knows it, versus the equal weighted one, is showing a 7.5-8% differential in performance over the last 12 months, which is because large technology companies have driven a lot of the performance of the NASDAQ and the S&P 500. Technology and communication services, the names like an Alphabet, a Meta, NVIDIA, Microsoft, etc. They've driven a large portion of the index upwards because they make up a large portion of the index. And so the whole index has moved. Whereas when you look at the equal weighted ones, not to the same extent. And so there are a number of lagging sectors and stocks in the index, which are actually still exhibiting quite good value, whereas the technology ones are perhaps looking a little more richly priced, following news about, well, firstly, decent earnings in Q1, but also the whole AI story over the last few weeks and months has certainly boosted a lot of these technology names. So we would be looking at thinking about things like changing from market cap-based ETF indices to equal weighted ones, and then looking at particular sectors and particular countries and particular themes you might want to express a view on.
So more defensive than you might have been in the past. Just if you can explain, I think they call them the Magnificent Seven, those 7 stocks that have pulled up all American shares. And hence, when people talk about the American stock market going up, those 7 companies have been the ones who've done most of the running. Is that a little bit like in the past, we always used to hear about the FANGs, Facebook, Amazon, Apple, etc., that there was a little group of stocks. When they go up, happy days, but if you are overweight towards them, when they turn, of course, not so good.
Yeah, and the acronyms have changed over time depending on the names of the companies. Google became Alphabet, and Facebook, which is an F, is now Meta. So the naming convention of that group has changed, and there have been a few new entrants in recent years, etc. So yes, those large cap technology and communication services companies are behemoths, $1 trillion plus businesses. They're massive, and therefore they make up such a large portion of these major indices. So a lot of stock pickers would argue that, you own the S&P 500, you own too much of these companies, they're driven by these names only, and there's a whole load of other dogs you get thrown into the mix when you buy that index. But the reality is there are other ways to express a view. You can own a particular sector. You can own a particular type of ETF, like an equal weighted one versus market capitalization one. You could use what's called smart beta or factor investing, which is a way in which these indices reconstitute their weights to stocks. So a value factor, for example, would overweight stocks that exhibit lower multiples, price to earnings, price to book, price to cash flow, etc. And you'd have more of those and less of the ones that exhibit valuation characteristics which are high. A momentum factor would overweight stocks which have had good positive momentum, underweight those that have had negative momentum. There are different ways in which the same normal index people would know can be reconstituted, and there are ETFs on those. And so it's not just S&P 500 or NASDAQ, and that's it. There are lots of nuanced ways in which you can express a view. And with 8,000 plus ETFs, we think we have an edge in doing that analysis and deep dive on the underlying holdings, how they're weighted, etc., to reconstitute how a broad global portfolio looks versus just buying the MSCI World ACPI or a large index like S&P 500.
It's a very important point you make there, because I remember talking with another South African who's based abroad, Sean Pesh, who said, in your BizNews portfolio, you've got the Vanguard Value ETF. And on the face of it, that means that if value funds or value stocks were doing better, well, that one would appreciate. He said, but you're actually not buying value shares because the underlying stocks in that exchange-traded fund are not what you think you're getting. You're getting a lot of the tech shares, actually, which had gone down and so on. So it's very, very complex. And I guess from an active manager's perspective, like your perspective, you've got to know exactly what is in there before you, to make sure that when you have a view and you've done all your research, that the positions that you take are actually what you're getting.
Yeah, absolutely. And actually, these factor and smart beta ETFs do have some issues with them in our view because they are sector neutral quite often. So they tend to overweight the stocks within a sector that exhibit value characteristics, which are often the dogs which are falling, hence they're cheaper. And you don't necessarily want them on their way down to a lower price. And so it's often better to express a value view through owning a value sector, perhaps a more defensive sector like pharma or healthcare, or utilities, for example, where they've got more stable cash flows, or consumer staples. So there are ways in which you can still express a value orientation without owning a value factor ETF, or just picking value stocks. There are ways in which you can express a sectoral view very easily in global markets today.
Before we find out exactly how you're positioned at the moment, is there or has there been a way to play this artificial intelligence boom? Some people in our portfolio, for instance, we've got NVIDIA and Palantir and Microsoft, which are three big runners on the artificial intelligence. As you said earlier, they are part of the Magnificent Seven, and they have, Palantir isn't, but they've really, really run hard. They can't keep running indefinitely, so you've got to be cautious about that. Are there opportunities, maybe even to short an AI exchange traded fund, or does something like that exist?
I mean, there are lots of new ETFs launches and even AI funds that are launching specific active managers, either in the private space or public space, trying to capitalize on this fantastic theme of AI. The problem with a lot of the large capitalization tech and communication services stocks is that AI is such a small percentage of the total business, often not even really revenue generating at all. But they have these units and teams and divisions doing AI. People jump onto that hype and they own the company. Now, will that become a major driver of revenue in the next 2, 3, 4, 5 years? Probably not. We're looking a decade or more out. So expressing a view by owning the large cap names is not really a pure play expression on AI. And a lot of the ETFs that have launched on AI similarly hold all these big tech companies. And, we were looking at one AI ETF, for example, that holds Spotify. I mean, Spotify is a music streaming business. So, why? Just because they are using some AI within the way in which they can generate playlists or whatever the story is, there's an argument they're AI. I mean, we can all agree they're not an AI company. So there are lots of things to consider when you just look at an ETF. Are you getting purity of expression? And in thematics like AI, you're very often not. So, it's something to do your homework on. But the theme is growing. It's very important. I think owning businesses which are adopting AI to improve the way in which they operate and potentially the margin and the earnings that pass through to shareholders are the ones to own, not necessarily those that just do AI exclusively. All companies focused on adopting AI and implementing that well. And I think those businesses will thrive. It's tough.
It's quite reflective, drawing on my gray hairs here, of what happened in the late 25 years ago, 1997, that anything that put .com behind its name was then affiliated as an internet company. And we saw a lot of that. And it's clearly the guys who are farming the market are seeing artificial intelligence as a way to draw in more income. But Mark, from your perspective, given all of this complexity, how are you guys positioned today for what's going into the future? And I say the complexity because there's no uniform view that we're back in a bull market. Some say we're still in a bear market. There's no uniform view on artificial intelligence. Is this the early stage of the AI stock boom, or is it going to be like a dot bomb where they've already had their run? How are you looking at this to take into consideration all of these moving parts?
As pertains to AI, we're not expressing an active view not to overweight AI. We've been overweight NASDAQ 100, and we've recently started to trim that because, if you recall, Q4 last year, we added to the NASDAQ and we had this conversation. I said, it's very difficult to tell the bottom, but given the moves down, we think now's the time to begin accumulating, which we did. And given this fantastic run we've seen in tech and communication services, we've been prudent to be moving out of some of that exposure into the equal weighted S&P 500, as I've just discussed. And I think, that's one of our core allocations is the US. That's what we're doing in the US market. And outside of the US, we're overweight Japan, we're overweight China. Japan has worked very well for us. China has had a pretty poor run. I think the post-COVID rebound hasn't yet occurred as people had expected. But the good thing is China can still cut policy rates. They're talking to the US nicely again. There's talk of fiscal reform. So hopefully China pans out in the next year or two. So those would be our two big Asian overweights. And then sectorally, we've been overweight autos in Europe, which has worked very well, outperformed our broader European exposure. But we've now started to shift some of that into more defensive sectors because of the economic environment being less certain. And so we moved to sectors like healthcare, for example. So within our global portfolio, we're making changes at a sector and country level, just being thoughtful about how things have moved, what's outperformed. I always use this cheesy line with the investment team, buy low, sell high. And, it's just about having good discipline and doing it. It's hard to buy low because when it's low, people are terrified and there's a reason it's low. There's bad news and there's been bad news, but it's not persistent. And similarly, when things have run very hard, there's exuberance and greed. And human behavior plays such an important part of the way in which we invest. It's trying to step away from that and just look at things objectively. Say, does this make sense? If I start with a blank sheet of paper, does it make sense? And sometimes if it doesn't make sense, it might be wrong. But you could be wrong for a long time. But if you, over a long period of time, make reasonably good judgment calls, you hope that you can outperform.
I remember very clearly towards the end of last year, the point that you made earlier about you going back into the big tech stocks and saying, well, they've fallen down, they might go a bit further, but this is a great opportunity. And my goodness, that has been a good call, and one that was brave at the time, because the perception amongst most people was their day is over and there is no bottom in sight. Still got a long way to go. So the point you made now about having the courage of your convictions, being able to go against the flow, how do you do that? How do you insulate yourself from the greed and fear that is all around you in the city of London, and be able to still make rational decisions on investing, like selling out when everybody else is buying?
I think it's a combination of keeping a level head and not letting the noise around you and the headlines in the press detract from logical thinking. And so applying good fundamental principles of investing is always a sound approach, knowing what those fundamental principles are, but then applying them consistently. I mean, I remember the COVID period in particular, clients being worried about the Great Depression and, this is Armageddon for the planet, and people were buying toilet paper and water, and the shops were selling out of baked beans, and it was ridiculous. And had demand for toothpaste and toothbrushes dropped 30, 40, 50% during COVID? No, people still needed toothbrush and toothpaste. So the stock price performance was overly negative, given the reality of the fact that, yes, we're in a lockdown, there's a slowdown, no doubt, but things are going to recover and there'll be pent-up demand that's building, no matter what sector you looked at. So it was trying to ignore this noise and panic and just keep a level head, saying ultimately there are 8 billion people on the planet. They demand goods and services. Goods and services will still move across the planet. Of course, there were supply chain issues, which drove a lot of the inflation. But if you take a long enough view, things just looked excessively cheap and people were overreacting. And the same does happen on the upside in certain things. So whether that's crypto and the booming crypto and a lot of what happened and subsequently happened, or whether that's AI, which was the tech bubble and bust, there are always people who are chasing the next hot, sexy theme. And sometimes they work, and sometimes you pick the right winner, but very often 8, 9, 10, or 8, 8 or 80% or 90% or 8 or 9 out of 10 of those businesses won't be around, even though the whole sector is a great concept. So, I don't know, like a Tesla versus the big German autos. Tesla's, in our view, very overvalued. Whereas the German autos trade much cheaper and they're building fantastic electric vehicles. And so, yes, Tesla led the charge, excuse the pun, on electric vehicles, but you've seen a huge growth from other big auto companies in Asia and in Germany. And I think you can own the theme in a different way, in perhaps a more balanced way, just thinking about, is the valuation logical? Does it make sense? Can they grow that fast? Are they really going to dominate for that long? Do they have IP that's not replicable elsewhere? And so the answer is often no. And so I think that's what we would want to look at with AI, back to the AI point, is, do these companies really have an edge? Legislation could also impact their earnings. We're still yet to see how the legislative reform takes place over coming years related to AI. So all this AI story is one thing, and then the next thing you'd have an announcement from regulators in particular countries curbing AI, and suddenly their earnings are going to all crash and stocks fall. So one has to sit back and just look at, what are the risks of doing this? And sometimes the hype is overdone. So it works on the upside and the downside, and just applying a practical, logical, thought out approach to investing is the one which we want to do.
Mark Perchtold is founding director of OMBA Advisory and Investments, and I'm Alec Hogg from BizNews.com.